Good afternoon, good evening, good morning, wherever you are joining me from. If you can hear me, let me know. Apologies that I'm fashionably late, as always. You will know that, you know, I like to be a little bit late. Maybe it just gives everyone a chance to catch up. But no, seriously, thank you for your patience. I was just getting ready here in the studio. I can see that there's a few folks. We've got Derek, Mitch is in the chat, being a bit of a menace, no doubt, and I can hear myself again there. JSK, you were just talking to me. It's great to have you join us for the show as well. So we're going to talk about a lot today. We've got Mitch. Mitch just did come back from a bit of a junket, so he was over in the overseas. Mitchell is our head of funds management. He would normally join me for these sessions, but I said, Mitch, you got back yesterday. Let me do this solo, just like I used to do for about 3 or 4 years. Did a live show every Wednesday for 3 or 4 years, and that was a wonderful community and really enjoyed that. So today we'll be able to answer your questions and have a bit of fun. We're going to talk about performance. We're going to talk about performance in a different context today too. There's going to be past performance, and then there's going to be present performance, and then there's going to be future performance. I'll spend as long on that as you want me to. My theory for today is that during the Trump Liberation Day sell-offs, which some of you will remember as April, there were a lot of people that were really scared about what the tariffs meant for global markets and in particular for your wealth. And as many of you know, that I took that opportunity to invest more, and around about 20% of our investors invested more, which was a real point of pride for both Mitch and I, because it basically showed that what we've been trying to teach everyone for 7 years now is starting to pay off. Everyone's starting to get more confident in what they know and how they invest, whether they do it themselves or so on. Chris, MyTubeNZ, Jimmy, Napoli Poems, like it. So Justin, great to see you, mate. Mick, you too. We're going to have a good bit of conversation today. I'd be interested to hear your thoughts. But if we go back to that moment in time in April, tariffs had just come in. Everyone was worried about what Trump was going to do, so on and so forth. And subsequently, as we now know, the stock market bounced back completely. But on the day, no one really knew what was going to happen. And I remember chatting to some people. We did a 90-minute live show here on the Rask YouTube channel. And within 3 days, I think it was 50,000 investors had watched or listened to it. And I think at that moment, people realized, as the Warren Buffett cliche goes, that it's not until the tide goes out that you know who's been swimming naked. And I think a lot of people that had a lot of confidence going in to the Friday beforehand realized by midday Monday that they'd been swimming naked. And so today, as we sit here today, I've been dealing with a lot of investors, a lot of really wealthy investors, a lot of investors getting started. Last 3 years, say, is very new investors, probably beginners is what I'd characterize that as, who, for the most part, are, I would say, very overconfident. So people that think that 10% returns every single year are virtually a guarantee as long as you invest in the stock market or property or pretty much anything. Like, the scariest one for me is actually private credit, which is this whole thing that people don't actually understand. And people are thinking that 10% returns are definitely on the table each and every year. Now, that might not be the case, so we can talk about that as well as a separate adjunct to today. But there was a good question that came through from Vanguard, and I'm glad it did, because I want to talk to you about that in just a minute. I'm going to share my screen and do all types of wonderful things. If we go here, I should be able to show you the Canva account that I'm working out of. Show you all the trade secrets here inside the Rask Canva account. We're going to talk about a few different things, but that was me with hair about 3 months ago, just before the Trump tariff thing. And subsequently, he's ruined it for me. So midlife, here we go. So general financial advice warning. I love doing these live shows. We love doing our podcasts. We love doing our free courses. We love giving personalized financial advice over on the other side of Rask. That's not here today. What you see here in front of you is general financial advice only. The information does not take into account your needs, goals, or objectives. So make sure you don't act on the information until you've spoken to your financial planner, or at least read the product disclosure statement, PDS, and target market determination, that's TMD. Those two documents tell you, this document here, so this one tells you like what the thing is. So for example, it would tell you what the super fund is or what are the fees. This one here, and this links to, I believe this links, hopefully it links, let's have a look. So this links to our one for our investment platform. And it shows you, as a good example, people are really new to these ones because these only came out a few years ago. It actually shows you, if you've got like an investment strategy, it shows you what the target is. It shows you what we think the minimum investment time frame should be, who it might suit, and also, all this other information. So you can make a really good informed decision. Whereas in the past, you couldn't do that because that document didn't exist. So make sure you read those types of things before you invest with anyone. And if you're confused about any of this sort of stuff, you can read the Rask Group's Financial Services Guide, which is available on our website. So today's update, I'm just going to talk about our portfolio performance because it's a good way to talk about things. Recap on any new positions. I'm going to do Vanguard versus Rask. I'm going to go head to head with the Juggernaut. And it's it's pretty good, I would say, but it's probably mixed. And then 10% returns guaranteed. And of course, we'll do some Q&A. As everyone knows, and basically everyone knows on our mailing list, that you can just Google Rask Invest, I believe. Let's go Rask Invest portfolios. Yeah, here you go. So you can just Google Rask Invest portfolios, and you can actually scroll down and you can see all of the different investment strategies, and then you can click through and you can see performance, net of fees, and then you can see all of these different things, like all the different holdings, where the country exposure is, what sectors they're exposed to, what methodologies we are pursuing, which is really informative for people who know what they're doing, and then just the asset classes as well. So you can use that, and then that way you can make an informed decision of, like, you can use that whatever way you want. You don't have to invest with us, right? So that's just an FYI. Yeah, cool. This is a good question from Mr. Leftovers. If someone I'll bring this up on the screen for people that are on LinkedIn or over on Facebook or something like that watching. So the question is, if someone puts all their money into one diversified ETF and sets it on autopilot, what's the worst 3-year scenario you see? And what simple rule would stop a beginner from panicking? Well, that's 2 questions in one, maybe even 10. It's a good question. Let's jump into that firstly. Let's have a bit of a chat about this. So what are the diversified ETFs? Let's start with that. So the diversified ETFs are the ones that I'm going to reference today, actually. They're kind of like the Vanguard ones, the Beta Shares ones. They are, let me just turn off my screen, actually, just real quick. We don't need to see that moon thing or whatever it is, sunrise. So the diversified ETFs are kind of billed as an ETF of ETFs. So you buy one ETF and then it splits your money up into more ETFs, which then splits it up into shares, property, securities, international shares, maybe some bonds and that sort of a thing. The real benefit of it is that you get a lot of diversification straight out of the gate. But as we've seen probably over the last 10 or 15 or 20 years, choosing the most diversified option is probably not the best thing. I think that's been pretty much proven now that you can choose one ETF that has like 5,000 shares in it from all around the world, but then it hasn't done as well as ones that have 100 or 200. And if you actually look into the data and the reasons why that can happen, is that there is a limit to how far you go with diversification at a point where more diversification doesn't actually add any benefit to it. There's a lot of literature on this. And so I'll come back to that in a little bit because it will bring an interesting point for people that are building lifelong wealth. That's the first thing. So that's a diversified ETF is like an ETF of ETF. However, that's how they're talked about, but they're not, most of them actually aren't like that. Most of them are actually an ETF of managed funds, which then have individual shares and stuff inside them. So think ETF at the top that you buy in your brokerage account or whatever. Then inside, there's another thing that then splits your money up again. But that thing that's inside is in some instances, is a managed fund, not an ETF. And that has tax drag issues. So Beta Shares did a good job of bringing out an ETF of ETFs, which is good. So that's probably the most common one. So the other part of this question was, what's the worst 3-year scenario? The good thing about diversified ETFs, let's bring up, say, the most popular one, from Vanguard, which is the Vanguard Diversified High Growth Index ETF, or VDHG is what everyone calls it. So the Vanguard Diversified High Growth Index ETF. Probably don't need that bit anymore, to be honest, but it kind of does say what it says. What it does, sorry. So here you can see it's got a bit of shares. It's got a bit of Aussie shares, international shares hedged, fixed income or bonds from international markets. It's got some small companies in there. It's got some emerging markets like China, India, that sort of stuff. Not much, but it's got some. And it's got Australian bonds and that sort of a thing. And if you look at like what's the worst 3-year performance, you can kind of see when there would have been a pretty material drawdown. There was one, wasn't actually that material, but you can see at the end of the 2021, it went from, just based on this number here, it went from $12,800 is what your $10,000 would have been had you invested back here. If you invested 10 grand back here is what this chart shows you. So it went from 12,800 down to a low of 10,900. So just using the back of the envelope, back of my brain math, that's about a 10 to 13% drop. So it's not that big, but that's not like a material crash, right? You can see it here expressed in dollar value. So like share price, I believe this is, or NAV. So you can see that it's gone, it looks bad, but this is probably a chart crime because the axis on the chart here is only showing, I don't know if you can see that, but it says $74 to $60. So if you actually zoomed out, it wouldn't be that bad. In fact, let's do that ourselves so we don't kind of mislead ourselves. So if we looked, it's not, that's also on a pretty generous scale. So it's not actually that big of a blip the more you zoom out. So that's not fully like what you call a market crash. It was just, it's good to see some diversification, because if you held, say, for example, the NDQ ETF by itself, that would be a more significant fall for you. So you would have had more volatility and more risk in that one. But over a 3-year period, you've diversified, you've got good, balance across the portfolio. So it's a bit of a smoother journey with those. And the final part of this is what simple rule would stop a beginner from panicking? One of the things that I could suggest straight away is that you don't actually log into your brokerage account. I think most people that use an ETF like VDHG, or even if we are unbiased by product issuer, if we go to say like the beta shares ones, this is not truly diversified because it's 100% growth. But say, for example, you went with one of these, the good thing about them is they are kind of, in my opinion, designed for beginners, because you don't really need to do much. You just set it up and then you can dollar cost average, or you can use a contribution plan, or somehow you just figure it out so that it kind of just runs itself. So a lot of the modern investment platforms, you don't even need to log in to do it. So for example, with Perla, which is disclosure sponsor of our finance podcast, as is BetaShares, not paid to say any of this stuff, by the way, but you don't even need to log in. You can just set up an automation. Same with our Rask Invest platform. You don't need to log in order to invest. You can just literally hit the button that says add money every month, or just send money via BPay to the account, and then we'll just do the rest. You don't even need to log in. So the first thing would be, for people that are more likely to, I guess, react poorly to a market sell-off like we saw when Trump introduced his tariffs, is just try and keep your distance. Like just try and not look at it would probably be the first thing. So what's that called? I think that psychologists, when they talk about addiction and that sort of stuff, they talk about those types of things. But let me just show you something. I'm just logging in over here. So this is inside the Rask Invest platform for anyone that hasn't seen it. So for example, you could just set up like a regular add funds thing here. So I think hopefully this doesn't reveal too much information, but you could just set up like a regular BPay, and you just go bang, invest the money. And it's really, really simple to do. This is not just us, but you could do with anyone, right? Like a regular contribution plan. You could just turn this on and set like you want to put like $500 a month in, just click save, and then you pull it from your bank account. So that would be the first thing, is just kind of keeping your mitts off the portfolio. Another one that we advocate for is, if you're a beginner, don't have like your brokerage accounts on your phone. It's just like unhealthy association, right? So just anything that's good for you, you want to kind of make easy in your life. Anything that's bad for you, you want to add friction. So, when you come into, I use the example of when you come into our house, the fruit bowl, when you walk into the kitchen, is the first thing you see, All right. So the fruit bowl, when you walk into our kitchen, you'll see the fruit bowl directly in front of you. In order to get to the box of shapes or the Pringles or the yummy chocolate, we actually keep that up the top, over the top of the oven, up the back. And why? Because it's better to have the thing that's easy and good in front of you and have the thing that's not good a little bit harder to get away. Just one extra layer. So for people that are investing, if you know you're going to panic, get a professional to do it, or just try and distance yourself from negative behaviors using the tools that you have. Use automation and those types of things. So I know that's a very long-winded answer, but that would be how I'd start thinking about that. And then obviously just further education is really important too. So keep your questions coming, guys. I've got plenty of time today. I wanted to kind of debunk a myth. Here we go. I'll just bring this up again. This is me when I used to give sermons on a Sunday afternoon. I'm just kidding. I don't anymore, but or at all. The only sermons I do are investing sermons, but I sometimes joke that it looks like I have a strange collar on there, but I can assure you it's just a white shirt that I happened to tuck in that day. So when we think about building investment portfolios, one of the things that we do is we don't just restrict ourselves to index funds. We don't just restrict ourselves to ETFs, although the majority of ETFs, like the vast majority, we don't just restrict ourselves to one style of investing. And we call this the best expression. It's called the best expression principle. And basically what it means is, like, if you're going to go for growth, it doesn't matter how you're going to get it, just do the best one. And if you're going to go for defensive income, don't worry about whether it's an ETF or a share or a property or whatever. Just pick the one that does the job the best. And so a lot of people get parochial and get quite philosophical about this. They're like, well, this is the only way to do things. That's often a very beginner way to think about investing, because it's kind of like watching a movie, but you only see it from one character's perspective. So imagine, when you're always like in the horror movie and you're like, wait, he's behind you and he's got the knife, he's behind the door. Can't you see that? Well, you're the character that's just walked into the room and don't even know that because you don't see it from all perspectives. And so the best expression principle is this idea in investing that we've introduced to the community here, which is that idea of try and see it from multiple perspectives and try and see it for what it is, not for what you think it is. And that's really important because a lot of people learn about ETFs the first time. They're like, oh, well, ETFs are the best. They learn about trading and they think, well, trading's the best versus long-term investing. A lot of value investors who read Warren Buffett, they're like, well, Warren Buffett's the best. So that's the only way to do it. Everyone is unique and there are good reasons to try different things. So this chart basically just shows you that in the orange there, we do use a bit of what we call active investing, which is where we would actually pick fund managers or individual stocks to do it. There's the index funds, which are more passive, and then what we call factor funds. And factor funds, I don't want to bore everyone to death, but factor funds are basically saying, well, we know that index funds just pick the biggest stocks and hold on to them, which obviously hasn't been a great thing for some markets. But also we know that there's another way you could do it. You could say, I just want dividend stocks, or I just want growth stocks, or I just want companies with high quality profits or something like this. You could choose whatever you want. We call those factor funds. You could have ones that have like multiple factors. So you could have, for example, one that targets, it has a rule that's like, we only invest in companies that pay dividends over 3%. And those companies must also have, I don't know, what's a good example? Must also have grown by 10% per year for the past 3 years. So what you're kind of combining there is you're combining income or yield, and you're combining momentum or growth. So you can kind of combine them together. We call those multi-factor funds, and we have one of those in the portfolio. And so you can see that kind of dotted in there throughout, just one of them. So one of the things I wanted to bring up, and this is I should have put this in the notes actually. I'm just going to pop this in here. I love a good disclaimer at Rask, as everyone knows. I'm just going to grab that. I'm going to put this on the screen for everyone. So this is as of August 2025, and this is net of fees. So I'm going to watch my disclaimer in real time, guys. Net of fees, past performance is not always indicative of future performance. It's not always indicative of future performance. Why? Because most people study returns like this and they make a decision solely based on that, which is not a good idea. Okay, so this just shows the 1 year returns. 1 year returns as of August 2025 net of fees for the different strategies. So you can see the comparable investment strategy for Rask Invest, so Jupiter, Marsh, and Terra. And then you can see the Vanguard equivalent of that. So you can see that the Jupiter strategy, the Martian strategy, I'm very proud of it, has done a little bit better. I don't think that math is, oh yeah, that's about right. And the Terra strategy is slightly underperformed VDBA. And so I bring this up because the reason that people target these diversified funds is often because they, one, have really low fees, and two, they seem to be really simple, which is good. But at the end of the day, as you get closer and closer to building a bigger balance and towards retirement, the one size fits all might not always be the right thing. So that's that. And then the other thing is fees. We charge 0.55% on our strategies, right? These ones are a bit lower than that. But there's also ETF fees inside our portfolios. And so what this shows you is that even though 1 year is not a great long-term return, so don't judge it purely off 1 year, but it's just an indicative illustration of how you can build your own ETF portfolio and you can get similar or better returns or worse over different periods of time. And I think one of the things, if I say, well, why did this happen? One of the reasons that this happened is because during the Trump sell-off, we took the opportunity to buy different ETFs. So we said, well, we've got VAS as a core holding. Where is it? So we've got in Jupiter, just as an example. So I use Jupiter most often because it's our most popular strategy. I think it's like 60 or 70% of people just use this one. But in Jupiter, we have the Vanguard. Where is it? The Vanguard Australian Shares Index ETF, right? So this is the biggest ETF in Australia. We have that. That's also included, not that specifically, this is an ETF. The one that's inside VDHG is not an ETF. But we have effectively the same thing as VDHG. The difference is when things got really sold off recently, we also bought ATEC. So ATEC, wherever it is, here, we decided that we didn't want to just own CBA, Woolworths, CSL, Westpac, and all of these boring businesses that are simply not growing. Well, CBA is, but they're not growing fast enough to keep up with their valuations. So instead, what we did is we took some of the money that was in VAS, and then we started repositioning it in this portfolio as well as VAS. So we had a little bit, like quite a bit more nimbleness to be able to do that. And I think this is one of the things that people should be mindful of when you DIY your portfolio versus using a diversified ETF straight out of the gate. Another thing is that we also moved into this. So for some of our portfolios, we also use this new Global X ETF called GXLD. The reason that we chose this ETF, not the GOLD, which you'll basically see it's the same thing. The reason why we chose our one, the one that we chose, over the other one is the fees, number one. But number two is this is a trust structure. It's more modern. It's easier to manage. It's not more transparent, but you could probably say it's more transparent. And obviously we chose gold because global volatility was on the rise with, Gaza, Ukraine, tariffs, these types of things. So you can see why you would do that. And that's why gold has spiked recently. So JSK, how long have these investments been operating? Is the actual strategies, that's a good point. I'll just bring it up here because it should have the since inception date here. So as of August 31st, I don't know the exact figure. Mitch would know if he's in the chat. It's about March 30, 2024. So just over a year. And that's why I use 1 year numbers and not longer, JSK. So that's why I do that. We've actually been running the similar strategies for our members for a long time, but this one itself has only been here. And we don't often like to talk about performance. They're going to find out why in just a second. So the next thing that I wanted to talk to you about today So I want to talk to you about DIY in your portfolio, the benefits of having your own portfolio or just having an off-the-shelf variety. Obviously, there are pros and cons to each option, but I wanted just to illustrate, kind of push back on people who are thinking that it doesn't make sense to, you always be 100% indexed. You always be all of these different types of things. I think we demonstrated this last year when we showed this. So in the Rask community, you'll see it as well. We demonstrated this, our research last year for people that didn't see it. We showed that effectively, if you took the different parts of the Australian market, you can actually see, this is all using ticker data, by the way, TIKR. You can actually see the composition of the Australian stock market. So what we see across the top here, and I'll leave this on the screen for a few minutes so you can have a think about it. We've got the different stock market indices. So the top 20 companies in Australia, the top 100, top 200, the top 200 minus the top 20, the top 300. It's not perfect. Like, this is not an exact science because the data is a little bit patchy, but it gives you an indication. Across the top, you can see dividends per share growth rate over 10 years. You can see earnings per share growth rate over 10 years. So like the profits growing. You can see the growth rate over 5 years. You can see the revenue growth. So that's just like sales, like Woolworths selling more stuff. You can see the revenue growth rate over 5 years. And you can see what we call the return on invested capital. This is effectively how profitable the businesses are internally. So when they invest money in their own business, what does that translate to in the return for next year? So you can see there's some common themes here, right? So over 10 years, you can see the big companies have paid increasing dividends. So CBA, Macquarie, Wesfarmers, dividends. But you can also see that the profits over time haven't kept pace with the dividend growth. So the profits haven't gone up as much as the dividends have gone up. So you can reconcile that in your own brain. How did the profits keep going up slower than the dividends they're paying back? And the answer is they can't. So eventually, if you have businesses that aren't investing for growth and aren't growing, eventually, I don't know when that is, but eventually their dividends stop growing as well. You could do what CSL did and take on more debt to pay dividends, but then you end up with more debt. So you're kind of taking debt into the business and then paid more dividends when you could have just not taken the debt and not paid the dividends and kept your business growing. So that's the difference of management strategy and what the board of directors ultimately do to companies. If we go across a little bit further, you can see revenue growth here. And you can see that the medium-sized companies, so like in that 1 to 200 range, if you include them in the mix, you actually get much better growth rates. So you start to see that the companies in the medium size, they're growing faster. So they're faster growing because they're smaller, they're not as influential. And so then finally what you see here is the revenue growth over 5 years, and you see even more acceleration from these medium-sized companies. And the final thing you see here, the pattern that you see emerging, is that larger companies tend to have more defined profits. So in Australia, we see like the banks, you see companies like Wesfarmers that owns Bunnings, Macquarie that is the big bank. Even nowadays, things like WiseTech Global, you see a lot of those types of businesses that have pretty good profit ratios. And the key point here is that if this is not positive, what happens is, you got Fortescue Metals Group, BHP, and all those types of materials companies in here. What tends to happen is if this is not high for very long, is that the business just crashes out. This has got to be consistently, I would say, above 10% on average for most businesses to survive longer term. It doesn't happen straight away because as a business is growing, it's not prioritizing its profits, it's prioritizing its revenue growth. And why is that important? I'll bring this up and show you. I just want to make sure. I should have prepared this in advance, but I didn't think we'd talk about this. So BCG 5-year profit growth. There's a report. I can't find it right now, but someone's probably seen me do it before. I'll see if I've got it in Canva just really quickly. Let's see. Let's go BCG. There we go. I've got it already in Canva. Let's bring this to the front. Okay, so what this chart shows you, and it kind of dovetails into what I was just talking about, is that when you're looking for growth from the stock market, right, what you see in this chart is that when you've got high-performing stocks, so like the top 25% of stocks, if you've got over a 5-year period, what you can see is that the biggest driver of the company's performance in stock price, so the reason the stock price goes up, is because the company's revenue growth is growing, right? Revenue growth. Then if you look at this here, which is the profit margin, that's kind of more like the ROIC figure you see before. But then over 10 years, so if you're investing for 10 years, what this shows you is that about 3/4 of the return, according to BCG numbers, they've actually updated these in a similar numbers, slightly less for revenue growth, but similar numbers. What you see here is you actually see the performance of stocks being driven by growth, not by the profit ratio or the price earnings ratio or the dividend yield. The actual driver of growth is the sales and the revenue, which makes sense, right? Because if you're investing for 10 years, you want the company to grow its sales. If it's not growing its sales, it's not a growing business. So why would you own it? Yet what happens is when people invest in just like the standard stock market, is that you end up with a lot of the big stocks making up most of the portfolio. So like in the case of the ASX 200, I think it's about 40 or 50%. Let's go and have a look at an ASX 200 ETF and see what comes up. So let's try the BlackRock one. I haven't been onto that website for a while. And feel free to ask any questions you have here, guys. So here what we can see is the top 10 stocks. So we can see 10%, another 7.5%, so that's 18%, 23%, and so on and so forth. So you can see a lot of concentration to the big stocks. So you can see 34% in financial stocks, 18% in material stocks. So you have a lot in these really big household names. I'll see if I can upload this to Canva. But effectively, what you're getting is if I come back to it, here we go. You're getting a lot of these stocks at the top. So you want to kind of diversify when you start to see that these companies simply are not growing. Because if a company's not growing and they're also, I'll bring this back up. If they're not growing, which we know describes the performance of shares, then why do we hold so much of it? So it's through a little bit of research like this that you can then determine, you can go, okay, well, maybe I should diversify a little bit away from the big Aussie tech stocks, big Aussie banks and that sort of a thing. Okay, so Mitch has just given us an update. Jason, you've said, in the last year, I sold out of my 93% superannuation in gold bought in 2019. I have a holding of 33% in the GXAI ETF, as well as a 5-figure sums in ATech, IAA, ESPO, which is esports, semiconductor, hack, FANG ETFs. Good idea. Well, Jason, obviously can't give personalized responses, sorry, mate, to tell you what to do. But what I can say generally is GXAI is one of the more popular ETFs for people that don't know about it. It's just a broad-based artificial intelligence ETF. It's gained a lot of popularity. And you can see why, because companies like Oracle that went up 30% the other day from building data centers and all that, Broadcom, which makes the chips, Alphabet/Google owns the cloud computing and Gemini product. We've got Taiwan Semiconductor, which actually makes the chips. Palantir, which uses AI to crunch data and to advise governments on how to use AI. Tencent is a Chinese business that has all different types of digital assets. Alibaba has its own language models and it has its own cloud computing business. Apple is not really an AI stock, in my opinion. It's not that much of an AI stock, but Netflix definitely uses a lot of AI to make recommendations. I don't know if anyone here has this. I don't know. It'd be a good question for everyone. If you've been in Netflix recently, say in the last couple of months, have you noticed that the the recommendations that Netflix makes for you have got better or worse, like the actual Netflix recommendations. Or if you're on YouTube, have you noticed that the videos that YouTube recommends to you are better? Now, while you're thinking about that and putting your responses in the chat here, I would say that it's definitely improved for me. I used to go onto my Netflix account and I used to see things like Peppa Pig and horror movies and things, frankly, I have never watched and didn't even know existed and I'm not interested in. Now I go in there and I see just everything that I'm interested in, which, by the way, is a lot of financy type stuff, few UK cop dramas, these types of things. I also don't mind a bit of comedy every now and again, of course. I like to cheer myself up after a day of thinking about Donald Trump's tariffs. But that's the kind of stuff that you see AI in practice. So this ETF encapsulates that really well. We don't hold it. Another way that you can get really good exposure to these types of themes and these types of companies is just to hold the FANG ETF, which I am very much a fan of. I really like the FANG ETF. You can see very similar names. It's kind of the ETF that would sit inside a portfolio. It's one of the names that I'll be putting to the investment committee, our investment committee, to add to one of our strategies. I won't say which one over the next few months, in addition to a few other things. But this is one of the names that I'll probably be putting to the committee because I think it's a great way to get exposure to undoubtedly what is the biggest trend in technology and biggest transformation we'll probably ever experience in technology. So like in our lifetimes. So yeah, what am I? Yeah, it's about the same for me, but it's a family account, says Chris. Yeah, I know that feeling, Chris. My mum used to have access to my Netflix account. And that didn't end well. Caroline said, what are your top 5 finance watches on Netflix? I went back and watched this one the other day. This is just one that I'll give you. It's called Inside Job. Now, if you want to come away hating the finance industry, I think this is the one for you. It was filmed just after, not that one. Let's go this one. If it was filmed just after the GFC in 2010, as the world was trying to make sense of what happened, it explains really incestuous relationships between the US big investment bank people and the government at the time and all the different things that happened. And Matt Damon actually narrates it, which is it's a really good show. And it obviously crucifies the finance industry, which at the time needed to be crucified, to be honest. So that's fine. A lot's changed since then, but that's one that I would add to people's list if they want to find out how the GFC happened and what it meant. So I want to quickly go back to performance and then maybe we can talk about some questions. So there is another chart here. I don't know if I've got it in my Canva account. I've got like a Leonardo da Vinci thing there. I've got the Rosetta Stone, but I don't think I have what I'm looking for. Let's see if I've got this from Market Index. There's a chart that I like from those guys. And I do not have it. Okay. So Market Index has this wonderful thing. Market Index is a great website for anyone that doesn't know it. Marketindex.com.au. It provides blog articles. It's got data on companies, and most of it's free, so it's a really good resource. But this chart is my favorite thing from all of Market Index. So what this shows is it shows the performance of the stock market here in Australia grouped into the kind of like a percentage returns for that calendar year. So like what was the return of 2025? What was the return of 2024? Well, you can see up there, it was between 10 and 20%, right? So you can see that this is very common. What you'll also notice from this chart, I think if you study it long enough, is that as time goes on, the average return from shares seems to be falling. So the average return seems to be coming down. The Australian stock market is one of the 3 best stock markets ever. It goes South Africa, Australia, and the United States. South Africa, Australia, and the United States. That is the order. But remember what I said before about growth and how important growth is for an economy. Over the last 100 years, we've had amazing companies in Australia. Many companies are still on the stock exchange. Companies like Washington H. Soul Pattinson, Commonwealth Bank's been around only since the 90s, but that's been a good business. Westpac, and so many other businesses. Ramsay Healthcare have stood a long time. AFIC and Argo have been around a long time. And so we've had some really good businesses. But on average, the stock market is kind of coming down a bit over time. That's what the data seems to suggest. Now, what I wanted to illustrate for you today is basically something like this. The way to think about when you build a portfolio, especially for retirees, this is really important to understand. If we think about the return of the stock market in like two axes, right? So we've got these things here. Typically, what we see over the long term is like a relationship between risk and return. So imagine that this is the relationship between risk and return on this line here. What we would normally see is something like this. I'll just bring this text bubble over. I'll do it like this. So down the bottom end, what we tend to see is we tend to see things like cash accounts and term deposits. So I'm just going to blow this up for everyone. 10%. We see things like cash. So put your money in a guaranteed government bank account. Then what we tend to see is things like government bonds. So they tend to see here. They tend to sit here. Then over time, what we see is we probably think things like hybrids, and we probably see things like, what would be next after hybrids? Probably maybe even something like gold. Even though gold is quite risky in the scheme of things, it tends to be viewed as a defensive asset. Then we'll see probably something like property. Even though property has gone up in Australia, yes, it is risky. Then we'll probably see blue chip shares like this. Then we'll see things like growth stocks, like say like more like technology stocks, that type of thing. And then finally up here, we would see things like emerging markets and small caps. So I'll just make that a bit smaller so it actually fits in. But that's typically what we would see. So something like this. What people seem to do in times like now, it's probably even a bit further up, is we see people moving quickly out of this. I'll just bring up my Mr. Squiggle. So what we see, don't like red in a finance presentation. So what we see is people going straight from their cash accounts or their offset accounts into stuff like this. There's even crypto, like crypto, if we were going to put crypto, like say crypto, I don't like to say that, we should say Bitcoin. Just because something has performed well does not mean that it's less risky. So Bitcoin would be like up there somewhere. But what we're seeing is, what unfortunately I'm seeing is a lot of people move quicker and quicker and quicker up this list. And then increasingly they're looking at different options like something like this, which is called private credit. And these often have lockups and you have to stay invested for like 5 or 10 years. We're seeing people jump to these things for income and that sort of a thing. So we're seeing people move further and further rapidly up the risk curve because what we've seen over time is that the returns up to the right have gone better. So if we measured like returns on this axis here, I should have said this to the start. If this is returns, we'll just go return. And if this is risk, and I'll just do the old cliche for risk. If this is risk on this one right here, what we're seeing is people moving quickly from like here in their portfolios rapidly to here, thinking that the stock market is going to rapidly recover. People are also moving into private credit really quickly. And in my opinion, when we're looking at a stock market where valuations are very, very stretched, a lot of people are moving straight into investments that they think they're getting a long-term compounding asset, but what they're actually getting is just a stretched valuation. So market index actually shows a chart on this as well, which I can reference here. So this actually shows that in recent times, if I zoom right in, it's a long time. This is like 50 years or so, or 30 or 40 years. You can see recently people have been really pushing money into stocks, and that's pushed the valuation considerably above average. So I hope that makes sense to look at that. So I see a questions come through here from MyTube. Is it more beneficial from a tax and currency exchange viewpoint to simply buy an ETF where the investor is domiciled? Yes, so that's a good question. So I did get this question. I had a conversation with someone the other day about this. Is one of the ETFs that people talk about is this ETF versus an ETF like IVV, which, full disclosure, we own IVV in our portfolios. So what's the difference between this one and this one? This one has about 1,500 shares and covers the entire US stock market. This one has 500 shares and just owns the bigger ones. All right, simple terms. The key difference is, though, the fees aren't that different. The key difference is that this ETF has a US tax domicile. So you got to fill out the W8 Ben form if you're familiar with that. And it does actually expose people to different tax regimes. So a really simple thing is people go, well, people say that this one, I think it's 0.03. Let's bring that up, actually. So this is a really good question because it exposes a subtlety in investing. So in this one here, we say that this fee is 0.04%, not much at all. With this one, which is the Vanguard one, you'll see it's 0.03. So 0.03, versus 0.04. So a lot of people just default to the cheapest option. But what they don't realize is the tax implications and the admin implications of having this one over that one. The reason that we use this one and not the other one, but not the only reason, but one of the reasons, is that this one doesn't have those same tax complications. So the answer to your question, MyTube, is that we prefer at Rask, this is not for everyone, but just for us, we prefer from a tax and from a currency perspective to always go with the one that is domiciled in Australia. So meaning that the legal tax domicile and the way it's treated for tax is in Australia. The key difference is that BlackRock / iShares here put in a little bit extra effort. And what they did was, effectively, when you invest in IVV in Australia, all investors, what you're actually doing is when you click buy on your brokerage account, your money goes into the IVV ETF, but immediately it's invested straight into the US equivalent of that fund. So money, I'll just draw this out for people who like a bit more of a drawn out thing. Just get rid of all that. So when someone invests in Australia, right here, they invest in IVV like this. What happens is that money immediately goes into, I think it's the SPY, is it this one? I can't remember the name of this trust, but I think it might be this, I don't know, whatever the trust this is. So this goes into the USA version of the ETF. But the key thing is this one right here is an Australian ETF. So this one, for tax purposes, that's my attempt at the Australian flag. This one right here is treated in Australia for tax. And that's what you're actually investing in on the stock market. With the other ETF, VTS, which is another popular ETF from Vanguard, is what's actually happening is this one, I can't remember what the US flag looks like. I think it's got like stars and stuff like that. And then it's got some whatevers. That one actually invests straight into the United States. So for tax purposes, if you were to buy that one, you're going to have the tax consequences that are outlined. And so it's a slightly different structure. It looks like the same. It's like having two identical twins, except one was born in the USA and one was born in Australia. And so that's why we use this one. And I think for most people, this makes sense to use Australian investments. I think a lot of the platforms that offer things like US ETFs and US trading, you just don't need to do it in Australia. There's over 450 ETFs or 400 plus ETFs in Australia now. You just don't need to buy overseas ETFs. You don't need to do that. And this one just happens to be on the Australian Stock Exchange, but it's a US trust. So a bit different. Trent said his favorite shows on Netflix for financing movies. Margin Call, great one. Really good one. Big Short, of course. Yeah. Moneyball and The Social Network and Playlist Spotify. I don't know that. Okay, cool. So that's how that works. Now, I guess we got to get to this point of, is 10% reasonable? Like, is 10% a reasonable return? I actually, when I think about it, if someone was investing for the long run, maybe is probably the way I'd answer it, is maybe. But the data seems to suggest that the average returns are coming down. So let me just get rid of, just quickly, just need to get rid of MyTube's question there. So if we look at, say, Curvo, EU FTSE 100. So if we look at the historical performance of the British stock market, I've been talking about this a bit recently, in the local currency. It looks pretty good when you see it like this. You think, oh, well, the British stock market's done pretty well. Finally, there's something good for England, right? Well, you might be disappointed to know that over 20 years, it's returned 6.4% per year before tax. 6.4% before taxes and before inflation. Over 25 years, if you stretch it back to like the early .coms when the market was pretty high, it's only 5%. So the actual return is not that good, right? Of course, if we look at, say, for example, we can compare it. Let's go S&P, P500. So if we look at it in, let's say we looked at it in US dollar terms. Now we're comparing the UK stock market to the American stock market. You can see for the first 14 years, the British stock market did better for the first 14 years. But then after that, the US stock market just ripped away. And so this highlights the benefit of diversification through time, in my opinion. It also highlights that you can't always assume that what has been a good thing for the past 10 years, or 15 years in this case, is going to keep being a good thing. So the question then might follow, well, why do we think this has happened? And one of the really simple explanations for this actually come from some great analysis that was done on LinkedIn. I hope I can access this without being logged in. Probably can't. So is this, I'm going to have to log in. Sorry, guys. 1 second. I'll see if I've got it somewhere else. I'll see if I've got it somewhere else, and then I'll bring it up for you. Just pulling it up here in a different tab. Sorry, guys. I'll be with you. If you have any questions, please drop them in now. Here we go. So in our recent weekend email, this was 2 weeks ago. If you haven't already got our email, if you have any feedback for me on our weekend email, please let me know in the community or just send me a message or whatever. But I spoke about everything we're talking about today on the Sunday email. If you've got a Rask account, if you're invested with us, if you're a client, you get this email every Sunday. Just make sure it hasn't gone to like your promotions or your spam filter or something like that. But in this email, I talked about like all the big blue chip stocks not doing too well. They're not growing very fast. I talked about like why we made the switch into certain, ETFs at the time that we did. So everything we've spoken about today. But I also referenced some other analysis. So what this chart, if I come back here, what this chart actually shows you here, I think this was from The Economist. Yeah, it was. It actually shows you the performance of the US stock market over 5 years if you didn't hold the big 7 stocks. So Amazon, Microsoft, Facebook, Google, these types of companies. You can see it really hasn't done anything if you excluded those. Only the big stocks have done well. So then why have the big stocks done well is the next question. It's because of this reason. And this comes from David Tuckwell of ETF Shares, new ETF provider here in Australia. And what it shows you is that the source of returns of the US stock market has come not entirely, but in a big way, if I just zoom out again, from this sector here, which is information technology, which of course is the companies that we're talking about, the Apples, the Facebooks, these types of businesses. You can see there and there. Google and that sort of stuff are in communication services. And then you can see discretionary companies. I don't know if Apple falls into that, but you see that as well. So what this actually shows you, in the dark blue, it actually shows you the profit growth of companies in this sector and profit growth of companies in this sector and profit growth of companies in this sector outperforming. So that's the dark shade of blue. What the pink kind of color shows you is the change in the valuations. So if it's on the right-hand side, it's meaning more expensive, like the valuations got more expensive. If it's on the left-hand side, it means that the valuation has gone down over time. So obviously in the US economy at the moment, parts of it are really struggling. So that's why we can see like discretionary companies. So this would be like retail companies that sell white goods or consumer products and stuff. That's come down. But we can see that in the information technology sector, actually, there's not much, like you can see it here. The valuations haven't really changed. What's changed has been the growth of the company. Dividends obviously don't really make a difference. So what this chart confirms for me is that if you're investing for 5 or 10 years, you have to invest where there is growth. You can't just assume that what has happened in the past is going to repeat in the future. This is what this chart is telling me, because it's kind of throwing aside that myth that just because share prices go up, they get more expensive. No. Sometimes share prices go up because companies are growing. And so your job as an investor, even if you're in ETFs, is to find those markets or find those pockets like AI or whatever it is that you're interested in, where you genuinely think the profits can go up. And so if we go back to our analysis of the Australian market here, we haven't seen the earnings growth from the big 10, 20 companies. And that's why I'm not surprised when I've read about it recently. That analysis was done last year. Why we're seeing these companies get sold down, because their share prices just can't keep going up if there's no profit growth. Like if they're not, it doesn't make any sense. So I hope that makes sense to you. So when you're thinking about your returns as an investor and you're thinking, well, where do the 10% of returns come from? I've kind of boiled it down to this, and you can take this away hopefully from today. Let's get rid of all this stuff. I think of the returns that we'll probably see. I don't have a crystal ball, so I don't know exactly what's going on, but this is how I try to think about it. Is if we think about the entire return of the stock market, say the past 30 years, typically what I would see in the past when I'd look at some data is I would see about this much is coming from dividends. So about 4%. I'd have to go back and check my data. I did this a few years ago. 4% from dividends and 6% from growth. Right? 4% dividends, 6% for growth, right? So that kind of makes sense, because over 30 years, by the way, guys, the actual Australian stock market, I should have said this before, interactive charts. This is probably the key point. I probably could have just led with this. I kind of buried this, but the key point is that since 1970, if I bring it up to today, wonderful chart from Vanguard, since 1970, I'll stop doing that. There we go. Since 1970 till July this year, the Australian stock market has returned 9.7%. So it hasn't done 10%. And this is before inflation. This is before the fees that you pay. And this is before taxes. So if you're sitting at home thinking, well, I'm going to get a 10% return every year, the data says here that the stock market over 50 years or 55 years now is suggesting to you that, oh, I don't know where that's going to come from. And I'll explain that in just a moment. So that is kind of the cold hard math. So if this was the return that typically people got from, we'll put GR next to growth and we'll say div next to dividends, right? If that was the return that people got historically, what we are actually seeing now, if I go back to our friends at Market Index, is that as valuations have gone up, the dividend yields have gone down because you're paying more for less. So the dividend yields have gone right down to 3.2%. So the yield that historically would average, what's that, around, say, 4%, like overall, there's been some ups and downs, obviously. It's just not there. So the yields, when you invest, have gone down. So for new money coming in, if we go back to, I think I've deleted it. Remember that chart that I had before where I showed like left to right the risk, and I was saying that in the middle area here is where kind of like, not in the middle, at the higher risk end is where shares are. Effectively, what we're getting at the moment anyway is we're getting higher valuations, lower income, and we just have to pay more for that. So the other thing is we're not getting the growth from the big stocks. That's here in Australia. Obviously in the US, we're getting some growth because you saw before in the United States, you saw that for the most part, the US companies are reinvesting for growth. So if you're an income-focused investor and you've been relying on shares, or you've been thinking you're going to get a 10% return and 4% is going to come from dividends, well, the dividend yields are actually lower, and the growth has been, for the big companies, it's been slowing. So in effect, the net result is it looks like you're going to get less growth, and you might even get less income. So do I think 10% returns are sustainable? I don't know. I have a strong, it could happen. Like, the stock market can still keep going up, even if the logic doesn't make any logic. So do 10% returns, would I be baking them into everything that I'm doing as if I was trying to model my wealth? No. But that's not an excuse then to go and try and find weird investments or different things that are really risky. I think you've just got to be very prudent around how you build a portfolio. So I know we went really, really deep on this, but does anyone have questions? Here's a good one. MyTube, another good question. So would that mean that for long-term holds, growth ETF outperforms div ETFs? I think that most investors, I don't know for sure, obviously, I'm just saying what the data says, but I think for most investors over the next, say, 10 or 20 years, I think we've got to be a bit smarter than just going with what worked in the last 30 years or 20 years. Like, it's not me saying go and put everything on red at the casino and just hope for the best, or go and buy all these speculative things, or put everything in Bitcoin. It's not at all what I'm suggesting. But I think my line of thinking is similar to yours, MyTubes. Like, I think that over time, what we're going to see is the people who make more money from investing are the people who tend to slice up and dice their portfolio a bit more. So I think that what we're likely to see is things like thematic ETFs. We know there's a lot of data against thematic ETFs. So I don't mean it like as in you trade in and out of thematic ETFs, but I mean things like, if you believe that global healthcare spending is on the rise and that will grow faster than the other industries, well, then maybe you have a little bit of the portfolio that's tilted towards that long-term thematic. Or maybe you think that, the rise of these technology companies is more valuable than just going into standard supermarket businesses that have done well for the past 20 years. Or maybe you think that, the banks aren't actually the future. There's going to be some other sort of thing. Well, maybe you can still have some banks, but you actually just tilt the portfolio a little bit more towards the more nuanced types of exposures that you want in your portfolio. And so I think the bigger picture is that, yes, Chris has said here, stocks will still be better than savings accounts. Absolutely. Like, the returns on cash is coming down. That's obvious. Absolutely. Let me just bring this up. So we have to see this because there's more money sloshing around in the system. We're going to have to see, this is the RBA interest rate charts. Now, if I've done one too many statistics classes at university, but I think that if I was to draw a line that projects where this is going, why don't we even do that? We'll take that. We'll drop it in here. Let's wait for that to pop up, if it ever pops up. Let me just bring this up. I don't know where it went. It just disappeared on me. Okay, it just disappeared on me. I'll just get that up again. I don't know where on earth that just went. I'm here on my Mac, so just bring that in. Still doesn't love me. I'm going to do it one more time. Okay, so it's not really loving me. Something's gone wrong with my iMac. It's time to sell Apple shares. There we go. Okay, so now I can bring it in. Sorry, guys. So if I get my Mr. Squiggle out again, it's still loading. That's why it's not coming. So anyway, so if I got my Mr. Squiggle out, what I'd be able to show you is that I think the course of interest rates is on the way down structurally. And that's because the governments are printing money. So the governments are printing more and more money, which is resulting in lower and lower value for the savings. Because if there's more and more money in the world, what is a likely outcome is that the money is worth less because there's more of it. So it's not really scarce anymore. And so what you would likely see is that over time, the rate of return that you get from the savings account comes down. Because if there's more money in the world, effectively what happens is what becomes more valuable are the scarce assets. And that's one of the big plays for Bitcoin, right? Is that there's only a limited number of Bitcoins. But it's the same for property. That's why property prices keep going up, because there's more money in the system. It's the same reason why superannuation keeps like pushing up share prices, is because there's more money in super. And so I agree with your sentiment, Chris, that I think over the long term, investing will always beat savings. I just think that it's also having a knock-on effect for investing, because if you have more money, you would also be inclined to invest it as well. So my choose, I'm only getting 3.1% on a 100K term deposit. However, it is parked there until I learn more about investing. Tim, yeah, good point. Most of the money supply is in the Australian property market. That's right. So like if the government's printing more money and subsidizing the banks, effectively where does the money go? It goes to property, it goes to cash accounts, and then it just eventually makes its way into the system. And so it pushes up the prices of things and eventually pushes down the return. Eventually, not straight away, but eventually. Oh, yeah, that's cool. Yeah, I am Martin. We can do that. We can do an episode on fractional property investing. Probably the most successful that I've seen in fractional property investing is Raise with its super estate thing, where you can have some of your portfolio actually invested in residential real estate. One of the things that we have in our portfolio, this is not a recommendation for anyone, but one of the ways that we get exposure to property is we don't use an ETF to do that. We use this one right here. It's a Charter Hall Long WALE REIT. It's not an ETF. It's actually, it owns like office buildings and that sort of stuff. And through that, you can kind of get like a long-term property return through time. So let's just take stock on some of this here. ASX Scalper, you've just come in with a great comment over on X. So you've said, I agree with you about QE. Let me just turn off this background so people can see it properly. I agree with you about QE and the effect of this, but I also think the erosion of the middle class, ETF flows, and many other things mean that PE ratios are no longer a good metric. And shares will continue to go up regardless. Assets are being drawn to the rich. Yeah, exactly. So that's probably going to happen, right? So that's a really good point. And this is why the returns from shares could stay higher for longer while more money is flooding in, even if the companies are not growing as fast. The returns from shares could stay reasonably high because there's more money flowing in. But ultimately, what would also happen is that if the growth isn't there, like we saw with Woolworths and CSL and CBA recently, if the valuations keep going up and up and up and up, and there's more money being pushed into it, eventually when they come out with bad results, everyone's going to be like shocked to the system, and the thing is going to crack down again, and it's going to fall, and then it'll probably push back up, and then it'll crack down again. And so we probably might end up seeing more volatility, like more ups and downs through time. But even that said, the data is kind of undeniable here. So if we look, I'll bring this up again, just with the Vanguard charts. The data's really just kind of undeniable. If people around Australia, around the world, are anchoring to 10% returns, well, since 1970, when interest rates have fallen from like 15% to near zero not too long ago, you've got two incomes in a household. You've got heaps of migration in Australia. You've got all of these different things happening, right? High paying jobs, these types of things, more education in Australia than ever before, with more people getting university degrees. So you've got all of these things, right? And the stock market has returned 9.7%. So unless something changes, I would argue that the macroeconomic forces aren't as positive as they were in 1970. Times were tougher back then, but you want to invest when times are tough, because then as they get better, you benefit from that improvement. But if we're coming from a base of things that look pretty expensive and we're not sure how productivity is going with growth and that sort of stuff, then where does that leave us? And there was a great report. I've only got two more things to rant on about today. But if I come back to it, there's this great report. I hope this is, it's the summary. Hopefully, is there a full one? This might not be the one, guys. So let me just have a quick look here. Just waiting for it to download. This is from UBS/Credit Suisse. It's a good. I don't read this end to end, but I look at it every year. So this is what I was saying before about the countries that have performed best in the stock markets and that sort of stuff. So this report tracks stock market returns since 1900 for these countries. Then it's from like 1951 for Brazil. Mexico started in 1969. So those stock markets are newer, right? They don't have as much of a robust stock market. So Bosnia-Herzegovina, that was 2011. Zambia, 2010, blah, 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 blah. What we can see is the size of the stock markets in the year 1899 versus 2024, which is really, really interesting to a lot of people. So the stock market in 1899 was the biggest one in the world was the UK. And now the UK, I think, is 4%. Somewhere else. I don't even know where it is. 3%, right? The US stock market went from 14% and then through the world wars and that sort of stuff emerged, and now it's got 61%. That probably gives you an indication of how great societies rise and fall through time. And there's another chart on this here, which might be fascinating to a lot of people. What this shows is it shows the proportion of all stock markets in the world through time and how big they are relative to the entire stock market. So you can see Australia is like this shade of red here, the kind of the highest shade of red in the chart. You can see that it kind of started pretty well in the 50s. It was going pretty well. And then we kind of shrunk relative to others throughout the 90s. We had like super high inflation, super high interest rates. Japan really made its way with like the 90s and electronics and all that sort of stuff after the Second World War. The USA has got bigger, Great Britain has shrunk, and I'm sure in another 100 years we'll see China somewhere on here with much greater influence. So that's probably this one here starting to emerge up the top there. I don't know if that is the case, but it looks like it's the case. So it actually shows you the kind of breakdown of the stock markets throughout the world over time. And it's fascinating to look at. So you can see in like the year 1900, an index fund would have had probably like 70% invested in railroad stocks. In 2024, it would have like 30% or just under in technology stocks. So it's fascinating to look at stuff like this. So the only other thing that I've got to say to you, and when you try and bake in 10% returns into your expectations, right? So say, for example, that we assume, this is probably a good way to dovetail into the end of the show today. So say, for example, you assume that the stock market in Australia is going to return 8%. Actually, I'll bring that down here. So say you think that the stock market's going to return 8%. Just why aren't you clicking? There we go. Like that, right? Typically in that, you'll have some growth and some dividends. So let's just say it's 50-50. You've got 4% of each. 4% growth, 4% dividends, like income, right? What you could do, and this is where things get a bit spicy, is you could say, well, if the base case is 8% for the stock market, remembering that bonds and everything else that was less risky will have a lower return, like cash and that sort of stuff. So I'm going to get rid of that there. And this one here. What you could then assume is that you could say, well, if the base case is plus or minus is 8%, you could then say plus or minus alpha. So let me just explain what that means for people that might be newer to investing. Alpha, which is a kind of gross term, but alpha basically just means the difference between the return that you achieve and the broad stock market or the broad market as a whole. So if you think about it, like if the stock market returned 7% and your portfolio did 10%, the difference is 3% alpha, right? So I wrote an email to people maybe about a month ago, and the title of the email was called Manufacturing Returns. And the idea of that was that if we assume that the world stock markets are coming down in their long-term return expectations, and we as individual investors have to assume that our returns might be lower than we thought they were going to be, What we then have to think about is like, well, can we do anything to try and push our return back up a bit? Most people are just jumping to risky things, in my opinion, like a lot of private credit, a lot of private equity, which is pretty reminiscent of every bull market when people start to get really euphoric. And then they're like, well, I'll just go more risk. And I don't really understand private equity and I don't really understand private credit. But the finance people on the telly said that this was good. Again, it's not until the tide goes out you realize who's been swimming naked. What we can then try and do is we can say, well, can we add any pockets of alpha to our return? And this is what I was saying before. A good example of what we tried to do, and it happened to work in the short term, but it might not always be the case, is that instead of having everything in VAS, which is the Vanguard ETF, we split off a little bit, just a little bit, into ATEC, which was the BetaShares technology ETF. And then we kept the remaining amount in VAS, right? And so that would be an example of how you don't have to be like taking huge swings for the fence. You can just be like, well, I just want a little bit more technology in my portfolio because I know from like what we're seeing in the world today that it probably makes more sense to have more technology companies in my portfolio or more healthcare companies or a little bit more Chinese companies or something like that. Or more AI companies, not everything, which would be a mistake, but just maybe a little bit more. And that's where you can maybe get a little bit alpha. So if everyone's listening today and they've made it through to the end, the idea is that I'm skeptical whether the 10% returns are sustainable, especially after tax and after fees and after everything. So you can use all of the things that have worked historically. You can use all those. And we still use, if we come back to this, we still use a lot of index funds. That's what the green is. We will do more of the active and passive stuff active and factor-based stuff in the future, but it would be on a case-by-case basis. We know that, for example, in bond markets, that index funds don't really work that well. They do work well, but they're not as good as many of their active funds management peers. So like in bond markets, typically active funds are better than passive funds. So active investment strategies versus index funds. And then if you own like a diversified fund that only does index funds, like these types of ones, you're just saying that, like, yeah, on the shares side, we know that a lot of index funds do really well, but on the defensive side of my portfolio, we don't know that. We don't have this. We know that a lot of index funds do well, but not as many. So it's kind of like a nuanced debate. And if you buy one size fits all ETF, you don't really have that type of control over the portfolio. So I hope that makes sense. But I'm happy to answer some questions for the last, say, 7 minutes here, because I was here for 90 minutes, which is what I did on the Liberation Day. So I thought I'd do the same today, because I'm probably more concerned today than I was on Liberation Day about investing, if I'm being honest. So I think there's a lot of people that have really high expectations and they're setting themselves up for a disappointment and probably be fearful when their shares fall. So happy to answer any questions, but thanks everyone for the praise here on YouTube. But JSK, when we talk about a percentage return, are we talking about this on top of inflation? That's a very good question. We are not talking about on top of inflation, JSK. So inflation could be like 3 or 4%, right? So you'd have to deduct inflation. If you're trying to figure out what your future living expenses are going to be, they would have inflation. Like the cost of cheese has gone up so much over the last 3 or 4 years. I keep on talking about this on our podcast, but the cost of like mainland cheese, my favorite is mainland vintage, has gone up like 40% in 5 years. It's maybe more now. So the inflation is real. So the returns are not in inflation adjusted terms. This is the thing about the long-term stock market return. So really interesting. It's interesting to me because I'm a bit of a data geek and an investment geek. I get that. But when I showed you before that chart that showed the stock market, Australian stock market's return over 125 years, the one that looked like a bit of a pyramid, a histogram is what it's called, and it showed an average return of 12.98% per year. If you strip out inflation from the historical returns of the Australian stock market, if you removed inflation, the actual return after inflation is in the 6% range. So it's like somewhere about 6.5%, I think, is what the UBS data or the Credit Suisse data suggests. It's about 6.5%. So the actual return after adjusting for living expenses and costs is mid to high mid-ish single digits. And so obviously if you have cash and these types of things, the return is actually probably negative, but even for the riskier assets. So Iamantum says, have you been keeping an eye on the crypto ETF flows, BlackRock, etc. return rates? Yeah, absolutely. So I think I joked about this on our podcast recently, but we do our investment committee meetings every 3 months. So I basically go to like a kind of like a small group of people and I say, this is what I want to do. Do I have your blessing that we would do these with the portfolios? What do you think? Pull it apart. And one of the things that I put to everyone was just, can we maybe think about offering some Bitcoin ETFs for our community, even if it's only like one or two of the strategies, just for people that do want that. Like I'm saying like 0.5% or 1%, like not a lot of money, right? They weren't really interested in it at the time. So I've kind of got to make the case to get them in there. But definitely watching it, I don't think that I've been pretty negative on cryptocurrencies and Bitcoin for a long time because I think it will have societal impacts. One of the reasons that we have a lot of money printing, for everyone that doesn't understand what that means, we just put more money in the system. This is the fundamental thing that everyone should understand, and they don't seem to talk about, is the reason that we have more money in our system is because if you allow societies to have massive amounts of inflation or depressions or anything like that, you end up with civil war and you end up with world wars. So I would rather our governments print money and keep people out of poverty than have things like hyperinflation in Germany in the 1910s. That is the reality. So we want governments to print more money, yet a lot of the Bitcoin community seem to think that having more money is a very, very bad thing for human society, when I fundamentally disagree. I think that the purpose of money is to keep societies balanced and fair and equitable, not equal, but equitable. And I think that is a fundamental misconception about why we have money at all in our societies. So I hope that makes sense. So I meant to be said, how can we hedge against the next recession? Rumors rumbling about the levels of markets gold. Yeah, so we added gold to our portfolios recently, Imantum. We also added the PIMCO bond ETFs. In addition, we also have some cash ETFs. And the idea here is that even in a recession, the money that is sloshing around the world has to go somewhere. Normally where it goes to the United States and the greenback currency, because the United States is still the most powerful country in the world, democratically, militarily, and even just with broader influence and technologically. It still has to be that place where a lot of the big pension funds and stuff would be happy to park their money, even relative to Australia, for example. And so most investors tend to see a flight, or we tend to see a flight towards the US dollar currency. So you tend to have, like, say, for example, in Venezuela, when there was a lot of uncertainty recently, like it's very uncertain, let's be honest, it's a tragedy. In Venezuela, what happened was a lot of people started using Bitcoin because they had no other choice. However, if you had US dollars, like physically had US dollars, you were basically rich because you had a currency that people could accept and then go somewhere with it, right? And so I still think we'll see, even in a recession, money has to go somewhere. So if you have, cash accounts and these types of things, this is the way we've interpreted it, is that you would still have that sort of a thing in a portfolio. But obviously, a lot of the finance literature that you see in the world is built not for that type of safety. It's actually built for volatility. So a lot of the literature that you might read about in a recession, what should you do with your money? A lot of the literature is trying to tell us to invest in lower volatility portfolios. But the reality is, the way I think about an investment portfolio is similar to the way I think about a personal budget. Is that when a recession hits, you'll probably have companies that are weak fall to the wayside. In a recession, you'll have companies that have a lot of debt go out of business. in a recession, you'll probably have individuals that have a lot of debt file for bankruptcy. In a recession, you'll probably have people that have invested in their career lose their job first. And so when it does come time for that, or even just a market crash, the response should be look for companies that will survive. Look for industries and investments that will thrive out of it. And that's what we saw with the ATech ETF and all of the technology stocks that are included in the ATech ETF recently, is they bounced back the fastest, as did like the big technology companies after COVID, and out of the GFC, we saw the companies and the banks that didn't have a lot of leverage recovered first, even though that was a recession. So I hope that makes sense. Yeah, cool. Mick, Graham said, would love to see a small exposure to Bitcoin ETF. Yeah, thanks, Graham. Yeah, that's one of the things. Like, is we would probably through one thing that Mitch and I haven't really talked about through Rask Invest in particular, but you could do this in your own brokerage account, is give people a little bit of exposure to allow them to choose their own kind of little extra bits. So the investment committee basically said, instead of us putting them in the core strategy, so instead of putting Bitcoin in like Jupiter or Terra or one of our main strategies, is to say to people, you can invest in it through our platform, and here are the ETFs that we think are the best ETFs for Bitcoin, but we won't put it in the core strategies. You can select that as like a drop down to add to your satellite alongside your core. I hope that makes sense. Yeah, Mick, you said, are you at all worried about the US interest payment defaults? Yeah, Mick, this is the thing that I talked about it last weekend in the podcast. I think people seem to have overlooked this. And I think this is in the near term, this is the biggest kind of political risk that we probably face as a stock market. Is for those that don't know, effectively, the US government, you probably hear things like debt ceiling a lot, or you hear things like the government's going to shut down. Basically, what happens is if the US can't refinance its debt because it's got so much, any government really can't refinance its debt. What effectively happens is people that work for the government don't get paid. And then once they do finally do it, then they repay them, kind of catch them up on their payments. So obviously the system can like freeze up. And that thing can then have an impact on like stock markets and things like that, where everyone's scared, right? So that is it's a real thing. It's happened many times over the past 16 years. The impact of it has been pretty negligible so far, and like maybe a few weeks or a couple of weeks of missed payments for government workers, and then they get repaid. This one potentially has the chance to be more significant, because effectively, while the Republicans in the United States have control of the lower house, and the upper house, there's still Democrats in there, and they kind of need them all to get along, and who knows if they will. So basically what happens for everyone's benefit is the government has a certain amount of debt, and then as that debt is due to be repaid to the investors who bought the debt, like pension funds, investors like us in ETFs, that sort of a thing, what ends up happening is the government then has to repay the debt with interest, so that the value of the debt actually goes up. It's kind of like repaying your mortgage, but you got the interest at the end as well. So you kind of need to do more debt to repay the existing debt, and then that you end up with more and more debt. And so realistically, most governments around the world, as you know, Mick, play with monopoly money. If you want more money, you just get more out of the box. That's what the US government does. That's what the Australian government does. That's what the UK government does. But the problem is, eventually, one day, the amount of debt that a government has and the interest payments on that debt could be so significant that the issuing of debt is only enough to cover the interest on the existing debt. And then there's more debt, and then you have to issue more debt to cover the extra interest on the existing debt. And then you just kind of get into this spiral. And that's basically what Ray Dalio was warning about. Well, he's been warning about for ages, but he warned about it a week or so ago. So I'm keeping an eye on that. We still have gold. We still have all those things in the portfolio. We still have cash. Yeah, hopefully the US government isn't going broke in the next 2 months. I hope so. Okay, probably time for just one or two more questions. I'll just turn Mick's question off there. Good one though. When it's a journey, when do you think, this is a good question for super peeps. When do you think the inflows into super will peak and outflows will pick up? Interesting question. We talked about this today on the Australian Investors podcast. Drew, or Dr. Andrew Derrimouth, as he's sometimes known, did an analysis, which who knows where he got his data from. He could have been making it up. But no, he wasn't. But he did an analysis of Australian super, which is the biggest super fund in Australia. He did an analysis and he showed that 4% of everyone that uses Australian super, 4%, are in pension phase. So what that means is that's past the point of retirement when the super fund starts to pay you back. So 65 plus for most people, 60 for some. That's the point. Only 4%, right? That means the other few million people are still adding money to super. So I'd say it's a long way to go before the number of people and the amount of money coming out is more than the money going in. Because if you think about it, what super is, it's increasing to 12%, beyond 12%. 12% of everyone in the country's wages going into superannuation. So that's tens of billions of dollars every 3 months, I believe, is my latest numbers. So I don't think we're seeing that yet. If you look at other investment platforms like NetWealth and Hub24 and Macquarie, their numbers are much bigger. They're bigger super balances because it's more cost effective. They're more financial advisor type people in retirement, and you do see more flows coming back the other way. But the big risk here is that if you've got those gigantic super funds, that the money coming out will outweigh the money coming in, which means that all of the investments inside the super fund already need to be sold in order to fund the money going out. So if there's not enough money coming in to match the money going out, they have to sell things like airports and toll roads that they might own inside these gigantic super funds. I don't think that's a big risk anymore, but it is something that people seem to talk about and get worried about. But they're really well regulated, and I think for the foreseeable future, a lot of people are going to be saving for their retirement because the age pension isn't necessarily getting any easier for people, and no one really, if they have the opportunity, they don't want to rely on the age pension if they can rely on their own super. So that's it for today. Been a great session. I tried to take it slow because we talked about some really complicated topics today. Hopefully, my intent was that so if people come to me and they talk to me about like wanting to achieve returns north of 10%, the only thing that I want to remind everyone is that historically, even the stock market, the good performing Australian stock market, has only really, depending on how you cut it up, has only really just met that, minus inflation, minus taxes, minus fees. Just set your expectations correctly. One thing I want to call out is that do not invest with us if you saw our 1 year returns and go, that's really good. They'll just keep doing that forever. That was the whole counterpoint to the show. So a lot of fund managers and a lot of investment people and even individual investors are thinking that they're really good investors right now. But remember, it goes both ways. It goes up and down. So get in contact with us via the Rask website. If you do want to learn more, you just want to ask some questions. But we'll be back every month to do this. So every month. So just you can subscribe on YouTube, or if you're over on X or Facebook or LinkedIn, wherever you're watching, you can jump onto the Rask website and get the newsletter. It comes out when does it come out? It comes out every Sunday morning. I often, because I've got a 5-month-old, I often end up writing the Rask newsletter at 11 p.m. on a Saturday night. I can assure you there's absolutely no AI that goes into our content. So it's all human read, kind of like doing these live shows. I'm Mantum. You said, can I check that you release all Rask talks on your YouTube channel? Yeah, we do. So 99% of them just go on the YouTube channel. So you can just subscribe on the YouTube channel, but it's about 50-50. Here's some fun analytics. So just going to click on this. So this is what the Rask YouTube channel looks like. You can just hit subscribe here and you get notified. What's really interesting, and for people that are also geeky on other types of data like me, is that about 50% of our audience is on YouTube and about 50% is on audio only. If you took the numbers on a raw basis, we have about 171,000 people a month tune into our YouTube content, and we have about 170,000 unique people tune into our audio podcasts. So if you go over 90 days, which is even bigger again, the audio is much, much bigger because most people on our podcast only listen to a couple of episodes every couple of months. So that tends to be how it all flows. But yeah, you can check out all that sort of stuff if you want to. All right, guys, thanks for today. Stay tuned for this Sunday's email and get in contact with us if you have any other questions or you want to talk portfolios or anything like that. Don't forget that any of the information that you heard today is general in nature. Please don't act on it until you spoke to your financial planner, and read the PDS and TMD. As I always said, past performance is not always indicative of future performance, as we talked about today. So bye for now. Have a great weekend. TGIF. Thank God it's Friday. Have a great week, and onwards and upwards.